Good morning, good evening, and good night. Hopefully, we don't put you to sleep, but I'm Jason Jacoby here with the ever so handsome and brilliant man, Mark Boyer. How are you today?
I'm doing great, but what's up with the good night thing? Like, good night now. We put them put them to bed. Hopefully, a little more exciting than
A little
that.
entertaining.
All right.
That's for sure. That's for sure. You doing all right?
I'm doing great. How are you?
I'm doing great. We had a great day in the markets today, wouldn't you say?
Yeah, we had a great day. Today was well. Let's say this. So just for the record, we had planned on doing this Boyer brief today. It's been on our schedule for the last couple of weeks. We had no idea the market was going to rally, 7%.
Yeah.
So for you clients who give us grief about that and just having fun with it, this was scheduled ahead of time. But today was a
Premeditated.
great day. You see here that the markets, the Dow, the S&P 500, the NASDAQ, and the Russell 2000 over the last year. You can see that, and you see it. You've also felt it as you look at your statements and so forth. But, we've been in this bear market, and you can see that, it's been in a downtrend most of the year, hitting some lows, back in June. That's the NASDAQ still dealing with here in October and November. But the Dow is only down 7% year to date, 7.37%, which is crazy to think about after how crazy this year's been. That index of 30 companies has really, really been strong. S&P, the Russell 2000, still down in the mid-teens, 16, 17%, and the NASDAQ, even after today, which was up how much? 7%?
Over 7%. Yes.
Yeah, and still down 29% year to date. So NASDAQ in the past has been the big grower. It's more volatile, just is. It's loaded with, stocks like Apple and Amazon and Meta, all these different tech companies that have gotten hit with higher interest rates, especially. So yeah. So anyway, good to have a market today, but we'll see if it has legs longer term.
Yeah, so speaking of today, obviously we just got done with midterm elections, lots of things up in the air, which we'll cover. But other good piece of news was inflation today, right? That's kind of a good reason for the spike. Can you kind of go into a little bit more differences between year over year and month over month? What do we look
Yeah.
at more? What do we
Yeah, I
favor?
mean, I
What's
think
going
the
on?
key thing is we talked about inflation here before. That's been the big fight this year is inflation rates. We've all felt it at the store, at the gas station, so forth. Paying our bills each month. It's just inflation's been really brutal. Year over year CPI today news was decreased to 7.7% from 8.2. So it's still significantly higher than most people that are well, most people that have been investing for the last 30 years are not used to, but older guys like me, I mean, we remember that inflation was way high in the 70s and 80s. So but point is today, CPI, core CPI, both came in lower than they have been and lower than expectations, especially month over month, which is really, really important. So the markets are expecting, when the markets expect a higher number and they get a lower number, that's to the market's advantage, because it means with lower inflation, the idea is that the Fed will be less aggressive with future interest rate, going higher. So they've been raising rates 75 basis points. The news is out, in December they'll do another 75, but what happened today is the odds of a 75 had just dropped to 50 based on these numbers. So I think the markets are rooting for the Fed to slow down. We'll see if they do, but that's kind of the reason the markets move so much today.
Good points. And inflation's a big piece of obviously where we are currently in the economic cycle. Are we in contractionary period? Are we in expansionary? Obviously not, but just in terms of there's different types of market cycles, right? And this year we felt it in our wallets, we felt it on our statements, felt it when we were filling up the pump at the pump.
Yeah, big time.
But in this, it's kind of a conundrum, right? Good news is bad news in a lot of things, and then bad news is good news in terms of economic cycle and for the markets too. So let's dive into it. I want to really open this up to the economy as a whole. This is going to talk a lot about job cuts and where we are with jobless claims and unemployment, but I want to bring you in after I kind of go over these quick stats here on your thoughts on the overall breadth of the economy and where we're going from here. So initial claims came in at 225,000 this week, or this past week, continuing claims were stuck at about 1.5, almost 1.5 million. So what does that mean? We have a lot of jobs, too few people to fill them. And we have a robust job market, right? Wages are increasing. If you want to get the employees that you feel you deserve or that you need to operate your business, you're gonna have to pay them a little bit more. But also with this higher inflationary environment, companies might have to borrow more at higher interest rates. But also, it's providing a scenario, a perfect storm of kind of a real wage deflationary period, actually, because you compare it with the inflation numbers, you compare it uh, to their wages, and it makes it look like there's actually a wage contraction because their money's not going as far.
No,
And
we're
now
not
we're
keeping
starting to
up.
see that with the big tech companies, Meta, Twitter, Microsoft's been talking about it, but Meta and Twitter have laid off at least it was over 10%, I believe, of their entire workforces in a single week. So, you're starting to see it. We've had clients, friends, family members, out of beginning to become out of work, and it's a weird time in the economy. So let's look at the numbers as a whole, right? Unemployment still 3.7%, still low. Where are we going from here? What's going to happen, do you think?
Well, the goal is for the Fed's trying to do is slow down activity to a place where that jobless claims go up, more people unemployed, less pressure on wage growth. All these things that's the idea of raising rates, is trying to lower demand in order to lower prices. Remember basic economics, supply and demand equal price, right? So you can either try to lower demand. If you're trying to lower prices, you either try to lower demand, or the other option is to increase supply. The current administration and what's going on here is they're trying to lower demand and cause these job layoffs and all these things in order to get us to slow down our spending and go from there. So anyway, that's what's happening. That's the good news is bad news. Good news for the market is bad news for people. We're seeing friends and family and different people, especially like in mortgage industries, whatever, are getting hit pretty hard. It's really, there's a lot of, you can argue all day about it. I mean, I think that, if you look at, frankly, if you look at the last couple of years of when inflation exploded, it's hard to argue against the fact that, from really day one of this current administration, they closed the pipelines for oil and gas. And from that day, you can see that inflation began to really expand, simply because, I mean, oil and gas costs are really in all kinds of things. So I think it's one area where you could actually increase. I mean, the point is that you don't have to just try to work on demand. You can actually try to create more supply by, that's one example. Also, deregulating some areas and so forth. There's a lot of things you can do on the other end too, that maybe, as we'll talk about here with a divided government, maybe some of these things can happen going forward. We'll see. We'll see what happens there. But unfortunately, bad news for some people here, and bad news for us being able to spend less. For those who are month to month and having to cut, is actually is what the Fed's really trying to do, and that's what a recession looks like and how it feels. So it's not fun, but I just encourage anybody who's going through it, persevere. God's got you. Hang in there. We will get through this. The hope is that they don't go too far, and that's what the market's like today. Is that maybe this will slow down the pace at which we increase interest rates going forward.
And just like you're talking about, so when they raise interest rates, it's not baked into the pudding right away, right? It takes a couple months.
Takes time. Yeah, it takes time to roll through. So these numbers, they still look strong labor market, but like you said, I mean, this week we're getting news of lots of major companies laying off lots of people. So those aren't even in the numbers yet. So we'll see that in the next couple months, 3 months. That I really see these jobless numbers should go up as we go forward. That would be the goal of the Fed in this environment.
Yep, absolutely. So talking about midterms, right? We briefly touched on divided government, divided Congress. So Senate's still up in the air. It's looking like the Republicans are going to take the House of Representatives by a few seats. That's just what the bottom right chart shows is the current makeup of government prior to the midterm 2022 elections. And then the net change of House of Representatives in the bottom left chart. So as you can see at the bottom left there, usually the incumbent, the presidential party that's in office at the time of midterms tends to lose quite a bit of seats. This year, there's a lot of talk on the news outlets and in the media about a red red tidal wave, even just because of the current economic environment. People weren't too happy about it, so that didn't materialize, of course, but still you're going to most likely get a divided government here, which is good for the markets, right? That's kind of what you just talked about. That's what we like to see. That's kind of what the S&P 500 specifically has done the best, right? In a split Congress.
Yeah, no, it's just like balance of power. It's as simple as that. I mean, history shows that midterms are a key time in the markets. We can have significant increases in prices over the next year after the midterms. I mean, it hasn't been, if you're looking at that chart there on the right, since the 50s. I mean, there hasn't been a negative midterm in that period of time. So it's just interesting to see it. You don't know how far it'll go, but point is, balance of power, having, checks and balances in our government is how it was designed to be. And so, the economy and so forth, and the markets, react positively, typically to that, most positively to that. And it doesn't mean they can't move if it goes the other way. It's just the best have been, kind of split governments in that area. So it's very interesting. We've been talking about that leading into this whole year. We've been talking about the midterms that, and it's, ironically, you can see even long-term charts, the markets. I think a couple Boyer briefs ago, we showed the chart of like from January to, October, the markets are typically down and negative, and then roll positive through the end of the year after the midterm. So, maybe we're the first step heading to that direction. We'll see.
Absolutely. And it's kind of interesting if you do look at the trailing 1 years after with this being positive. It'll be interesting to see this next year, right? With recession likely on the horizon, or even that we're in one, right? It's that's kind of our thought right now. We're in a shallow recession and probably going to get worse here in the next year.
Yeah.
Especially, keeping above 6% inflation over a rolling 12-month period is pretty detrimental to the markets. From a chart we actually showed last May or April, I believe it was, when inflation kind of started to hang around a little bit, but that's to be seen. But it's quite interesting to look at, and we'll see kind of in the next year how that unfolds. But in a nutshell, I want to get your thoughts also on our portfolio positioning, some things that we're doing right now at the end. I think that's really key. I really think, a lot of people don't see what goes on behind the scenes. They just look at their statements or their mobile apps that they have on their phones and computers and see, oh, that's how I'm invested. And but we do a lot behind the scenes, don't we, Mark? We really kind of look to tailor the portfolios for each individual investor. There's no cookie cutter portfolios here. We really do put the client at the center of our investment philosophy, which, again, when we just started, we officially named it Project X-Ray. I know it's not the coolest name. It's not like, Batman's underground cave or some kind of cool layer or something, but Project X-Ray, like basically being able to look through the portfolio and not put it into traditional style boxes, but more, again, keeping the client's ideas or ideals, whether it be how they want to invest or their goals. We put that at the center of the portfolio and build it around that with dividend equities at the core. So I want to get your thoughts on that, and then we'll kind of do a quick synopsis there of this year.
Yeah. So, like Jason's talking about, we're always monitoring these places. And I think the key here, especially as we looked at that chart there, is that, again, your time frame is critical for those who have longer time frames in a market like this. History shows that the best course of action is to stay in the market. It's time in the market versus timing the market. Reason why you don't want to be out of the market is, some of the best days of the market are in rallies off of bottom. So that's really important. And then just, asset allocation. We're doing a lot of dividend paying stocks as, really it looks to that there's sort of a transformation going on currently, just from growth to value. We'll see how long that lasts, but the fact is dividends have always proven to be huge, very advantageous in portfolios with the large cap, and that's kind of why you're seeing the Dow, I think, move so much, because those are all typically dividend paying companies and so forth. So I think the way I would see any short-term money, if there's any of you that have short-term needs and you're going to need your money here soon, rallies like this in the midst of a market that we've had the last year, just make sure you're communicating with us, as if you need money. We want to try to take that money out when we get these rallies. We'll see. We don't know how long they last and if it's got a longer term horizon. But point is that just make sure you're communicating with us in regards to what your needs are, and as we talk and as we work together, just communication is really critical, so we know what you're going through and what you're dealing with. So that's really important for us.
Absolutely. Well, we're in a brief synopsis here, in a nutshell, inflation starting to come down, both core and headline inflation. Housing costs are starting to come down, excluding rents. Well, rents are just starting to come down, actually. Used car prices, medical care products. There's just consumer services are starting to come down. So it seems like we're starting to kind of feel the effects of the hikes, the hawkish Fed that's kind of been in play here this year, which is a good thing. Maybe they'll slow their roll here in December, and then maybe pause in 2023 and let the rate hikes kind of catch up and get baked in and get baked into the economy. But it's still looking like 50 basis points again in December on the 14th. And then we'll kind of go back.
So I would still think interest rates are going up. I mean, the Fed wants to get down to 2% inflation, and that's going to take an continued aggressive rate hikes to do that. I think the next 6, 9, 12 months are going to be challenging. Again, it depends on the time frame. That's why we're talking about time frames and so forth. I think today we got some good numbers, but who knows? You don't know day to day what's going to happen in there. We are bullish in the near term, especially since the year we've had. We could see the year-end rally happening, but next year, I mean, there's a lot of things that are going to be going on, and so I think we're clearly not out of the woods. It's not. We just got to continue to monitor. And again, the key here is asset allocation, diversification, which is always, it goes back thousands of years in wisdom, and time frame. That's how you manage portfolio. That's how you manage risk in portfolios. Is what is your time frame? Fixed income looks like it's just gotten a rock this year. We talked about that former briefs, but now it's interesting to see, like, the dividend yields are pretty high. So those are attractive in here, for new money or whatever. So anyway, everything's case by case, person by person. We're here to help you, and excited to do so. But that's, the next 6, 12 months are going to be interesting to see what goes down. So
absolutely.
Overall, we do those bear markets. This is what I do know, that every bear market, good news in the midst of bad news, is that good news is bear markets have always ended. And it's created a new opportunity for long-term investment. And so that's I think that I'm excited about, or at least we're getting closer to that place. We'll see where it ends up being, where that next cycle starts to the upside.
Absolutely. Yeah. Absolutely. We're active managers taking an active approach in your portfolio. So remember that. But if you have any questions, reach out to us. We're always here. We love serving you all. And if we don't serve you yet, we would love to have a conversation about that as well, and see if there's an opportunity to help you out along your financial path and journey. So anyway, this is this month's Boyer Brief. Hopefully we didn't put you to sleep, but we'll see you next month. Have a good one.
God bless. Bye-bye.